Auto insurance can all seem the same until it comes time to use it. So don't get stuck paying more for less coverage. Switch to USAA Auto Insurance and you could start saving money in no time. Get a quote today. Restrictions apply.
This episode is brought to you by Loom by Atlassian. Are you feeling stuck at work? Get your team unstuck with Loom video messaging and move work forward. Use Loom to simultaneously record both your screen and yourself to share a quick update, provide feedback, train a colleague, and everything in between. Plus, add Loom AI to your meetings for instant written notes and recordings. Try Loom today at Loom.com. That's LOOM.com.
Welcome back to The Bull, your personal finance podcast. There are great people who work on Wall Street, and then there are great people who are Wall Street. Barry Ritholtz is arguably one of the latter. From the trading desk to wealth management, from op-eds in the Washington Post to blogs and Bloomberg podcasts, all the way down to that incredible stream of brilliant content produced weekly by the superstars working at the firm he founded, Ritholtz Wealth Management, like Josh Brown, Michael Batnick, Ben Carson, and Nick Maggiulli, just to name the ones best known here in Italy. For what he has built, and for the impact on me and my own understanding of the world of finance and investing, Barry Ritholtz was truly the guest I've dreamed of introducing to you for a very long time. And there couldn't have been a better moment to sit down with Barry than now, with the long-awaited release of his new book, over 15 years in the making, in which he distilled all his immense knowledge and wisdom to help investors everywhere better manage their money, starting with a deep understanding of the most common mistakes they make. As they say in these cases, How Not to Invest is already destined to become a timeless classic of personal finance literature. With Barry, we talk about core principles, especially useful for staying the course during turbulent times like this. But of course, in an interview recorded on April the 7th, just days after the Liberation Day market bloodbath following April the 2nd, I couldn't help but ask Barry for his authoritative take on the whole Trump tariff saga, which may well go down as the worst self-inflicted economic decision of the century. But without further ado, here's my conversation with Barry Ritholtz. Enjoy the episode. Dear Barry, welcome to my podcast, The Bull.
Thank you so much for having me, Riccardo. It's a pleasure to be here.
It's a great pleasure for me to have you here on the other side, since you are typically the interviewer and now you are the interviewee. But that's a great occasion for us all to get some insights from you about investing and what's going on in the markets. And of course, we are going to be talking about your highly anticipated new book as well. But before we get the conversation started, I must admit I had a doubt because we are now in a, let's say, particular moment and things seems to be falling apart. My doubt was if it were better to start talking about this craziness about tariffs and the market bloodbath. But then I realized that these are just things that come and go, while learning how to invest is a more important thing. Therefore, I would like to start with how not to invest related stuff, if you don't mind.
Okay, sure. I'm in your hands, wherever you want to go.
Oh, that's great. Before diving into the book's content, would you please walk us through your incredible journey? You started with physics, and then you end up being one of the most authoritative voices in the media ecosystem and in the world of wealth management.
Sure. Originally undergraduate of physics and applied math. I figured out after a year or two that, hey, I was pretty good at this stuff in high school, but those guys are great. And I can't keep up with them and work that hard. I'm not wired to spend that much time in the trenches. So switched to political science and philosophy, didn't know what to do with myself, ended up going to law school, which I very much enjoyed, passed the bar first time out, but really didn't, love being a lawyer. And when there was an opportunity to work with a client, to go in-house at a firm that was actually the predecessor firm to E-Trade's online trading, as a trader, I jumped at it and spent the first 4 or 5 years of my career on a trading desk trying to figure out why the things that you assume drive day-to-day market actions really don't matter that much. And that the key thing you learn on a trading desk, there's a few things you learn. One is you learn risk management. You learn only to swing at the sort of trades where the odds are in your favor. But you also learn a whole lot about the decision-making process and how to hone your instincts and about human behavior. You find that a lot of people, how about everybody, brings a lot of emotionality and evolutionary software routines. The human OS, the operating system, is really built for something entirely different than making risk-reward decisions. And I was kind of lucky that in mid-90s, I kind of discovered behavioral finance before all the cool kids discovered it. And it very much shaped the direction my career has taken over the past 30 years.
You went through several market turmoils, and then bull runs, and then turmoils all over again. This made me think about why you might have decided to not make prescriptions about how to invest. You decided to start with how not to invest, via negationis. You study philosophy, so you know this Latin expression from the medieval philosophers, which means discovering the truth by eliminating illusions and misunderstandings. So why this decision, starting from the mistakes and not directly addressing the good stuff?
Sure. Well, my last book was about 15 years ago, Bailout Nation. And over the ensuing decade, I've had a number of friends, family members, publishers kind of say, hey, so when's the next book? But, life gets in the way. We launched the firm in 2013. Building that from nothing to $5.5 billion was a lot of work,
really
a lot of effort,
impressive,
a lot of focus. I had been writing continuously on one blog or another since 1998. So that sort of scratched that itch. I really didn't feel the need to do another book. And the last book was kind of exhausting. It was cathartic to get all that stuff off my chest. But that book was a little bit of a slog because every time I thought I was just about finished, another company blows up and I got to go rewrite that chapter, and then another company blows up. And then, September 15th, Lehman Brothers and AIG go kablooey. And now I have to rewrite a whole section of the book. It was exhausting, constantly making changes in real time. So I needed a decade to recover. And finally, someone had asked, maybe it was Morgan Housel who had asked me, or Craig Pierce at Harriman House, said, what's the hesitancy to write another book? I'm like, what's the point? We've had 10,000 books telling people how to invest. Everybody's still a pretty mediocre investor. What, do we really need to add another doorstop to that pile? Do we really need another tome telling people what to do? So I kind of put it aside for a while and really wasn't thinking about it. I came home from vacation after Christmas in December 2023. And, there's that dead spot between Christmas and New Year's. You have a few days to kill. And I just started looking at the quarterly calls I had done for clients and market research and analysis and columns for the Washington Post and Bloomberg. And it kind of dawned on me, gee, I spend an awful lot of time telling people what not to do. Maybe there's something there. So when I referenced this to the publisher and to Morgan Housel, everybody seemed to be really enthusiastic on what not to do. Here we are.
It seems like investing is more about doing less than doing more. This is kind of the bottom line of what I've learned over the years. There are a lot of enemies along the way, and in your book you mention a couple of very bad guys, which are bad advice and the media's overflow of information, which is mostly noise. How bad they are and how do they impact financial decisions in your view?
So when I started working on the book, I just started writing down different chapter ideas on these 3x5 cards. Literally, each one of these is a different chapter. And I just posted it on a big bulletin board, started rearranging it, and eventually 3 core ideas showed up. Bad ideas, bad numbers, bad behavior. The ideas stuff were really kind of the most fun because nobody is obligated to follow the advice they hear on TV or in print or on any newspaper or magazine or any social media, but they all have a very pernicious effect on us. They deeply affect our thought process. And so as I was putting together the outline of the book, the first task was, how do I demonstrate to people that you can't simply blindly follow anything or everything you hear in financial media? And I kind of came up on the idea of saying, everybody pretends they know what's going to happen in the future. Nobody knows anything. By the way, it's not just finance. It's film and music and television and real estate. And wherever you look, there are experts telling you, here's what's going to happen. And we tend to believe them because A, they're experts, and B, they've been really successful. And so it turns out that's a terrible approach, that most of what we see out there is just speculation and opinion, and I think, I feel, I hope, very little real analysis, very little actual understanding of what's happening today, and that makes it really challenging to figure out what's going to happen in the future. And so I wanted to demonstrate right off the bat, if you need to be Nostradamus, if you need to be able to predict the future to have a decent economic or financial outcome, you're in deep trouble.
Yeah. This is both reassuring because you don't need to forecast the future to be successful at investing. But at the same time, it's terrible because we are not made that way. The uncertainty is terrible for us. The way we are made, it's not to deal with uncertainty. And we would like to have that expert telling us, keep calm, things are going to be fine in the future. And this is exactly what is going to happen. I think this is the tragedy of investing and at the same time the very ultimate source of its return, because we need that uncertainty in the first place to have a return at all. I think this is what most people don't get, maybe because we have some biological problem with that.
So normally, think about modern humans have been around for 400,000 years. The fairly modern humans are around for a couple of million years, and we evolved to adapt to changing conditions on the savannah. We never had to figure out, is this muni bond or is this dividend yielding stock attractive relative to its peers? I find that stuff kind of fascinating. And so, fight or flight is our instinct. The idea is, what do we need to do to stay alive long enough to reproduce, pass our genes down to the next generation? We never really had to deal with thinking very long and hard about the future. I find the whole uncertainty thing kind of amusing because it's such an obvious rationalization. Here is the truth. Here is And we never like to admit this, but here's the cold, hard facts. The world is fairly random. A lot of things happen that are wholly unanticipated. Serendipity and chance play a huge role in our lives and in the lives of companies and markets and economies. And we don't like to admit that. And so we create this happy little bubble around us. We construct a model of the world. We've been doing that since we're born. It's cognitively expensive to build your model of the world. And it doesn't have to be perfect. It just has to be good enough so that you can cross the street without getting hit by a bus, right? It really doesn't have to be perfect, just good enough to survive and pass your genes along. And what it doesn't do is it doesn't give us a comprehensive understanding of what's happening right now. It certainly gives us no insight into what's going on in the future. But we can lie to ourselves. We can exist in this, hey, I'm in a bubble that allows me to operate every day. It allows me to get up, get dressed, feed myself, go to work. That's all it needs to do. And we don't like to be reminded that this is a very, very rough estimate of the universe around us. And for the most part, for most of the time, we could, we could bounce around in our happy little bubble. Whenever I see people on TV start talking about uncertainty, what that usually means is something bad is going on that has popped that delusional bubble, and we have lost the ability, temporarily, to lie to ourselves, to rationalize what's going on, to forget pretending what's happening now. We pretend we know what's going to happen in the future. So I love the uncertainty meme because it's just such a beautiful way to reveal, like, hey, maybe we should be a little more humble about what we think we know today and have a whole lot more humility about how little we know about what tomorrow brings. And the application to investing is very, very significant. You need to create a portfolio that's robust enough to survive an economy that expands and contracts, a market that goes up and down, and that is filled with random events. Nobody in December 2019 had on their forecasts, by the way, global pandemic, close the world economy, and stock market's going to be great. Like,
Absolutely.
Nobody had that.
Absolutely.
And I could show you every year the Russian invasion of Ukraine, the Israel Hamas war, the Federal Reserve raising rates 500 basis points, stocks and bonds down double digits in the same year, first time in 40 years. It's amazing year after year after year. There are always all these surprises, and yet we continue to blithely make our forecasts like we have any idea. I just saw this morning Bank of America Merrill Lynch, lowered their estimate for the S&P 500. They lowered their forecast by 1,000 points, by 20%. Wait, you had no idea? Didn't Trump tell us he was running on tariffs? Hasn't he said that he's tariff man? Not that I forecast this, because I don't forecast anything. But, wait, you made a prediction, you ignored that, now you have to drop your S&P target by 1,000 points from 6,600 to 5,600. P.S. We're already way below that. So it's kind of fascinating to watch this play out in real time. The dumb luck of the book is that it came out. Again, I'm thrilled to be on the lucky end as opposed to the unlucky end. It came out at a time when a lot of the lessons in the book are, hey, no one knows anything. No one knows what's going to happen. All this stuff is sort of random if you look at it over the short term, and over the long haul, here's what stocks tend to do over the decades.
Yeah, we kind of need to build narratives in hindsight to make the world logical, because we cannot live in a world with no sense at all.
That's right.
Another reason why we are typically bad at investing, it's something I really believe in. As I told you before in the third episode of this podcast a couple of years ago, I said that we are very good at basic mathematics. We are good at plus, minus, times, and divided by.
Arithmetic, not exponential.
Exactly. Arithmetic, not exponential. We are very bad at exponential math. But investing is all about exponential.
Yeah.
Starting from the compound interest and the other stuff, like the fact that if markets drop 20%, then it takes more than 20% to break even.
That's right.
And you talk a lot about it in your book, about this problem we have with math.
Yeah, there's a lot of problems that we have with math. Not even talking about the math phobic, but we evolved in an arithmetic world. Nobody had to calculate compound returns over decades or centuries. It just wasn't a skill set that was necessary. So if you never had to develop that skill in order to survive, it's not intuitive. Some of the things that should be a little intuitive, I think we just kind of have to nudge them. And I'll give you... let's hold off compounding for a second. The context of context and framing, like you have to put numbers into a broader picture. You have to frame them relative to what's going on. So the examples I use in the book, company XYZ lays off 10,000 people. Well, what does that mean? I need some framing I need some context. The technical definition is called denominator.
It seems a big deal.
Is it a big deal? Is 10,000 a lot? Well, if it's a local company with 30,000 employees, laying off a third of your workforce, that's a giant deal.
Sure.
But if it's Walmart and they have 3 million or 2 million employees worldwide, that works out to be
quite
one
meaningless.
Employee every fifth store is getting laid off.
Sure.
I think they probably lose more than that just in the daily hiring and people quitting. And so without that context, there are two numbers, right? The media loves to give us one number, but everything comes with two numbers. The first number is, what is the change? The change is 10,000 people are laid off, market dropped 500 points, things like that. But the second number, the denominator, is what are we talking about? Down 500 points on the S&P 500 is a 10% move. Down 500 points on the Dow, well, it's a 0.5% move. Nobody cares. It's daily noise. So that denominator blindness is very famous because we don't look at the entire data set. And you don't need to be a math whiz. You just need to say, what is the context for the change that I'm hearing about? 10,000 people, a lot or a little? 500 points, what market are we talking about? What company are we talking about? And we see this over and over again, that it's very clickbaity, it's very attention-seeking, but it's not really informative. It doesn't really teach us what it's like to, what these numbers mean. We're not intuitive. We haven't been trained to ask that question, and I think it's something that we should. At the high school level, people should understand basic context framing. That's before we get into probabilities and statistics and more, university level things. But just something as simple as, and I give some fun examples in the book. A magazine ran a story about the epidemic of selfie deaths. They were like, oh my God, there's been 97 selfie deaths. What's the context of selfie deaths? Well, the Google I/O conference discovered that we were doing something like 93 million selfies, pictures a day, right? So if over the course of 6 years, more people die falling out of bed than they do taking selfies, according to the data. And so when you see stuff like that, or shark attacks, or terrorism, and then the parallels to markets are, we're afraid of market crashes, we're afraid of hyperinflation, we're afraid of all these things that come along rarely. Even this insanity we're dealing with today barely qualifies as a correction, and it's not quite yet a full-blown crash. And this is a self-inflicted wound. This isn't your normal course of events. we typically don't expect this sort of stuff from politicians. This is a once-in-a-century sort of self-inflicted wound.
Yeah, totally. We're going to talk about it later in the episode because I'm very interested in getting to know what you think about it. Well, actually, I know what you think about it, but it's going to be interesting to deep dive a little bit into the topic. But when it comes to investing, I believe you are a great fan, as I am, of systematic or passive investing, whatever you call it. So, buy low-cost index funds and ETFs, get an exposure to the market according to your risk tolerance, risk capacity, and stick to it. But a couple of episodes of Mastering Business that I loved hosted David Einhorn and Mike Green, and you obviously discussed with them possible threats coming from passive investing. Both claim that passive investing could break the markets and make price less elastic and so on and so forth. What do you think about it, and what's the case for passive investing in your opinion nowadays?
So let's do the case first and then the structure second. So the case for index investing, at least as your core of your portfolio, pick a number, 50, 60, 70%. That should be your core. And, if you want to do something else, it's because you want to outperform the market. You want to generate alpha. But you can't generate alpha if you're not at least starting with beta, right? What the market gives you is beta. So if your core portfolio is 50% index and you want to add some flavor to it, I'm just making up a random assortment of shareholder yields, India, momentum, Japan, emerging market small cap index, value, whatever, emerging market small cap value, whatever sort of spin you want to put on, hey, if you think biotech is great, if you think, AI is great, well, then buy an ETF for that. That's 3 or 4% of your portfolio. And now you have exposure to that, and don't worry about it. But at least the core of your portfolio is giving you what the market gives you. So that is that's just what the data shows. In any given year, less than half of active managers, less than 50%, outperform the benchmark, outperform the indexes. You take that to 5 years, it's 83% fail to outperform. You take it to 10 years, it's 90-something percent net of fees. You take it to 20 years, it's practically nobody. Like, the reason people like Peter Lynch and Warren Buffett are household names is because they're unicorns. They're just, they're Ronaldos and Messiers. They're one-of-a-kind players, and nobody...
Yes, because you can expect extreme outliers in any distribution.
That's right. But the reality is so few people beat the index over the long term that's why that should be the core of your index. And whenever I hear criticisms about passive or low-cost indexes, I always start with that. Well, the reason I'm paying you is to more than I'm paying an index is to generate above-market returns, and you haven't shown an ability to do that. So that's number one. Number two, I don't know. I've been hearing people warn about changes in market structure now my entire career. And if you go back, I did a column for Bloomberg. Passive it's Marxist, it's un-American, it's going to destroy the economy, it's going to crash this. It's all these things that everybody has warned about. None of them have come true. And so how long have we been hearing, hey, in the next market crash, two things are going to happen. First, passive indexing is going to be revealed as a structural problem. And second, that's when the active managers are going to shine. That's when they'll outperform. And we had this in 2000 during the dot-com implosion, the financial crisis in 08-09, the flash crash in 2010, COVID in 2020, the tariff tantrum in 2025. Hey, what do we need to do in order for active managers to earn their stripes and for passive investing, index investing, to destroy market structure? And the answer is, I don't know, because every time we keep hearing these warnings, here's what's going to happen. The one I heard most recently was passive is going to destroy price choice, price discovery. Passive is not going to allow us to understand what is going to happen with all these different companies. And and the Magnificent Seven is a perfect example. Well, look what's happened this year. The Magnificent Seven were overvalued, especially in light of the tariffs. And so they came down dramatically, really hard. The other 493 in the S&P 500, they're significantly outperforming that. The index is adjusting automatically in response to what's going on. So price discovery seems to be going on fine. I don't know at what point price discovery starts to fail. Andrew Lowe, professor of finance over at MIT, said you could have indexing be 90%. Not only would you still have plenty of price discovery, but that's where active managers really should have an opportunity to take advantage of mispricings, market inefficiencies, arbitrage opportunities, like the greater, and by the way, passive indexing has surpassed active in the world of mutual funds and ETF. It's now over 50%. But broadly speaking, the vast majority of assets are still actively managed, both globally and in the United States. So far, all the bad things we keep hearing about haven't happened. When you warn about something for years, for decades, and it never comes true, I kind of think maybe this is just the boy who cried wolf, and you have to take it with context. Wait, you're saying that Eric Balchunas wrote a piece for Bloomberg and eventually became a book called The Vanguard Effect that said Vanguard has saved investors $1 trillion in fees. And by the way, that was in 2016. A decade later, it's probably over $2 trillion. Gee, you think maybe that has something to do with why the active managers are unhappy? I don't think they give a flying fuck about market structure. I could give you 2 trillion reasons why they're unhappy with indexing. I don't think market structure is the top of the list.
Maybe they should put tariffs on index funds to make active funds more competitive.
They've tried. They've testified in Congress, and they've tried. And, here's the ironic thing. It's their own fault. It's the active manager's own fault. They did a poor job performing for the past 50 years. They used to charge ludicrous fees. It was only because of Vanguard they were forced to decrease fees. We found out in the 1990s they were bullshitting us about the performance because they just very casually removed all the funds that underperformed, closed, went out of business, were merged. That's where we learn about survivorship bias in finance, because academic studies showed, hey, once you include the companies that did really poorly, the funds that did poorly and were closed, the outperformance disappeared. So a half a century of lying to investors, underperforming, overcharging. Gee, I can't figure out why BlackRock has $11 trillion and Vanguard has $10 trillion. Why do you think that happened? It's because of them, because of the poor job that so many active managers have done. And I love Bill Miller's quote, a very successful active manager who beat the S&P 500 15 years in a row. And he blamed active managers because he said they're all closet indexers. If your active share is really low and you want to lock in at least some market performance by making 3/4 of your fund beta, well, then how do you get away with charging 150 or 200 basis points? So Bill Miller has basically said, from a different perspective, hey, active managers, if you want to earn your keep, you can't be closet indexers. And so I know they're constantly flailing, looking for excuses to attack indexing. All you have to do is beat the market net of your fees, and you can justify your existence. And there are a slice of people who do that every year, and there's some people who do it pretty consistently, whether it's in private equity or hedge funds or venture capital or actively managed mutual funds. But they're few and far between, and we really don't know who they are until after the fact. That's the problem, is a handful of folks get lucky or are talented, and we figure it out when it's too late.
Yeah, Michael Mauboussin did the math, and it turns out that it takes 64 years to have a statistical significance about what is skill and what is luck in active management. So you have to be patient to discover it.
So sometimes you find out sooner. In the book, I use the reference of Cathie Wood's ARC. And by the way, she put up one of the greatest years ever in an ETF return, right? 2020, she's up 164%. I think peak to trough to peak, it's like 350%. And she's doing what she's supposed to do. She's picking aggressive stocks. That's what that fund does. Someone else did the analysis that I reference in the book. 92% of ARK investors are underwater. It's not anything she did wrong. It's that the investors, after the stock ran up 190%, that's when they jump in. Most investors underperform their own investments. And that's just the nature of us people and the media. She was feted in all the TV shows and all the magazines and all the websites. Everybody talked about, and nobody was even in second place. That was just like an unprecedented year for a mutual fund. She got Bitcoin right. She got Tesla right. They all had giant years.
Coinbase,
NVIDIA, like everything she touched turned to gold. Now, since then, the fund has underperformed, and since inception in, I want to say 2014, 2015?
2014, I guess.
Yeah, she's underperformed the S&P 500 since then.
Yeah.
And to be fair, the better comparison is the NASDAQ, because she's a high-octane growth portfolio. But that's the way we are. We see the shiny new object. Ooh, look how pretty, and then we go chasing it. And investors have a tendency to substantially underperform their own investments. They buy high, they sell low, and the drawing I included in the book, repeat until broke. And too many people behave that way. Carl Richards' drawing is the most insightful thing I've ever seen, because it sums up both the cycles of the market and human nature perfectly.
Yeah. I think ARK is the third biggest wealth destroyer in the U.S. Morningstar did the math in terms of wealth destroyed by mutual funds and ETFs.
So, yeah, I don't blame ARK. ARK is just saying, hey, we're going to buy the highest beta, most aggressive technology companies. It's not their fault. It's the fault, to some degree, of the media, who basically proclaimed her the next Peter Lynch. And it's our own wetware. It's our own operating system that, oh my God, talk about FOMO. Look at how much that ETF has run out. What an amazing year. And rather than say, maybe I missed it, everybody says, let me jump onto that. And so, the same thing. People buying Bitcoin at 100,000. All right, where is it today? 77,000? It's not that that's a bad trade. It's that after something runs up 100,000 points, maybe you missed it. Like, that's just a way to think about this. NVIDIA, perfect example. I think NVIDIA is the first U.S. company to lose $1 trillion in market cap. They didn't do anything wrong. Investors said, oh, I really like NVIDIA. At 3 trillion, it's going to 5 trillion. Well, after that sort of run-up, you have to always ask yourself, what's more likely? Record-breaking 3 trillion, just unimaginably giant number? Or maybe we digest these gains and we give a little back. And I'm not saying this in hindsight. You could do this with Cisco in 2000, with GE in 2005. You could look at all these companies and say, after they've had a record-breaking run, right? Is this where I want to deploy my capital? Look at Tesla, perfect example. Even Apple, which everyone was so blindsided about the tariffs, Apple and Amazon are suffering from this. We need to be a little more thoughtful about chasing stocks upwards when our greed button gets pushed. And we also need to be a little more thoughtful about panic selling on the downside when our fear button gets pushed. It turns out the academic studies say both of those are terrible ways to invest.
Yeah. So, and it's very relevant today because we are recording this on April the 7th. It's 9:30 in New York, and the S&P 500 is way down for the third day in a row. To start with, I really don't know how to frame the questions because I have so many things to say.
We're down 4.5% on the NASDAQ, a little over 4% on the S&P 500, and about just under 4% on the Dow.
Wonderful. I don't remember 3 days in a row that bad, even during COVID.
No, this is like we're not experiencing the same level of sell-off that we did during the financial crisis, but I think you got to go back either to the pandemic or the financial crisis to see 3 days in a row where you're off about 5%. It's pretty hefty, and it just goes to show you Trump has talked about tariffs his whole adult life. He called himself Tariff Man. He ran on this, and despite that, we all had a failure of imagination. Nobody really believed that he would implement tariffs that were potentially this destructive to the global economy, to trade, to GDP, to consumer spending. And so what you're seeing is the stock market. All right, so the stock market's a future discounting mechanism saying, here's the price something is worth today. And what that is some multiple in the future times earnings. And essentially this big 3-day readjustment, I don't know when it ends, is the market saying, oh, we previously thought, profits will be up here. Now they're going to be down here, and price has to adjust to reflect that. We'll see how much further this can go, but we're down. Let's take a quick look at the numbers. The Russell is down. Before today, the Russell was down 18%. The NASDAQ down 17%. The S&P 500 down 14%. We're now pretty much, 22, 23, and 18 across the board. And so the market is saying we overestimated future profit growth by a fifth, maybe even a quarter, and we're adjusting downwards, which is really significant.
Absolutely. The question now would be, why? Why should one inflict that damage to the wealth of his whole nation? Because I understand that most of Trump's voters may not invest in stocks, but the richest 10% of Americans own most of the stocks and account for half of the entire consumer spending.
Right, 87% of the stocks and 50% of consumer spending, exactly.
Therefore, Wall Street is Main Street. There is no distinction. So why doing this?
So there's let me unpack two questions built into this. Why and how, right? The why, I'm friendly with Ben Hunt of Epsilon Theory, and they do this really interesting thing, and I just sent you that link if you want to include that chart. They put together a big data set where they're scraping things like Substack and blogs and news outlets and social media, and they run an analysis where they're looking for semantic signatures about different subjects, what they call linguistic markers. And so when you see how often then candidate Trump discussed tariffs, he was mostly talking about protecting a domestic industry. That makes sense if you're a candidate running for office and you want to win votes in Michigan and Wisconsin and Ohio, where the automakers were. But he also talked about reshoring manufacturing, which makes some sense. And he talks about, he kind of briefly talked about replacing the income tax, which doesn't make any sense. It's very regressive. It hurts his voters the most, and you just can never generate enough revenue tariff-wise to replace, income tax revenue. But then after he got elected, everything kind of changed. And so some of the reasons became pressuring neighbors to secure their borders. I'm not sure if that makes any sense. Pressuring other countries to lower tariffs. All right, that makes some sense. And then getting other countries to pay for their own defense. What does tariffs have to do with that? So the takeaway from this has been this is a policy that they want that has been in search for a reason, for a rationalization. Because they keep just trial ballooning different things. Let's run this up the flagpole, see if anybody salutes at this. There isn't a coherent reason to implement these sort of draconian tariffs. I mean, Vietnam is a tiny country. How on earth can we close a trade deficit with them? They'll never be able to buy as much American goods. Like the amount of discretionary income per person here. Like if everybody in Vietnam spent every penny they earned buying American goods, it still wouldn't close the deficit. It's just not mathematically. So that doesn't make any sense. I first saw the tariffs on penguins in Antarctica, and I thought that was a joke, but to me, that sums up the thinking behind this new policy. We put tariffs on penguins. So it's kind of hard to understand the thought process behind that. Now, where things, the thing I wrote up this morning, the consequences of chaos, the way this was implemented was very ham-fisted, very unprofessional and opaque and clumsy. This is nonpartisan. There's no other way to describe this. Think about when the Fed raises rates or when the Fed cut rates. They spend months leaking out information, letting Wall Street know, here's what's going to happen, here's how we're going to implement it, here's the data we're looking at, they don't want to shock Wall Street because they want this to be a gradual adjustment. And instead, I kind of get the feeling that, the shock is part of the underlying motivation. It's almost as if the White House is trolling Wall Street. And what you're seeing is, generally speaking, Wall Street said, hey, we supported you because we were looking for a much more business-friendly environment. We want an FTC, a Federal Trade Commission, to not enforce antitrust laws. And we would love some more tax cuts and we would love some more deregulation. That's why we supported you. This stuff is not what we thought we were signing up for. And so you're seeing this sudden readjustment. And maybe had they communicated this a little more effectively, if there had been a plan, you get the sense that everybody's spitballing. Like even the formula that they used was pulled from ChatGPT, and it makes no sense. It's kind of, and I'm really, I do our quarterly calls for clients every quarter, and I had to say, hey, this is nonpartisan. I'm just telling you what I see. It's impossible to describe this as thoughtful, with clear goals and objections, communicated transparently in a way that the world of finance and economics understood. I don't think it's partisan to say none of that is true. This was just kind of blundered into, and that's why you're getting this kind of market reaction. There's a bottom eventually coming. I just don't know if it's today, Thursday, a month from now. It's kind of hard to tell.
Could it be part of a wider negotiation strategy, in your opinion?
That's my best case scenario is, hey, there are going to be all these side deals, all these phone calls. They'll do a series of one-offs. This will eventually settle down, and we'll end up with a deal that is, more attractive than what we're looking at here. Like something, that's the best case scenario. They keep saying they're not doing that, but I'm expecting somebody to cut some deal, and then things start to normalize a little bit. But I don't know when that's going to happen, or if that's going to happen. They keep saying they're not doing that. So it's kind of challenging to see what's going to go on there.
Today reminds us of what happens just for the magnitude and not for the context, of course, in 1987, when the market wiped out 30% of its value in a week, 22% in just one infamous day on October the 19th. In your book, there is a great quote with two people, with one saying something like this: "Oh no, this looks like 1987 again," and the other one, "So you're thinking the market is going to grow 37 times in the next 4 decades? Do you think we are in this kind of environment, or should this be the right attitude going forward?"
So keep in mind, 1987 was 40 years ago. It was a very different market. It was a very different structure, the way things were traded. The volume was so much less. There was portfolio insurance, which started this whole negative spiral. I don't really see the parallel to 87 here, although that chapter you're referring to, the quote from Eddie Elfenbein, the chapter is reframe your perspective. Very often when you see like a down day like this, you have to say, all right, this is what happens. Markets go up and down. You have to look at it from a healthy perspective, so you're in a position to kind of ride it out, because that's what happens when you have these policies that are so substantial and so damaging. So I love the Eddie Elfenbein quote because people always use 1987 as an example. Look, here's what happened when the market crashed. But they always forget it's the framing. It's the other side of the ledger. Hey, you had a terrible day in 87, and 87 was a pretty bad year. You went from up 40% to up 1% for the year. Don't you think that you should also look at what the market did over the next 10, 20, 30 years? People cherry pick the worst. And look, this sort of catastrophizing is what human nature is. You're very concerned about existential threats. Psychologically, the good times are temporary, but something really dangerous potentially risks everything going to hell. That's a significant factor.
Wow. That's a nuance of optimism on which we can close the conversation.
Yeah. This too shall pass. I mean, it's still going to be painful to ride this out. I have no idea how much worse this gets. But, the next time they come out, they're either going to say, we cut a deal with England and markets rally, or we're not cutting any deals, and then they'll sell off again. We're sort of subject to the president's whim, which is not a comfortable place to be.
Sure. Barry, thank you so much for this amazing conversation. I highly recommend your book about how not to invest because it's more relevant than ever today.
Well, thank you so much for having me, Ricardo. It's been a pleasure. Hopefully the next time we speak, there'll be green on the screen instead of red.
I hope so. Thank you so much. Bye-bye, Barry. And that's all, folks. I hope you enjoyed the episode and that Barry's insights into how not to invest and how to approach the current situation we're all experiencing were as inspiring for you as they were for me. Huge thanks again to Barry for accepting my invitation. Don't forget you'll find the link to his incredible book, How Not to Invest, in the episode description. As always, I invite you to hit follow and turn on notification on Spotify, Apple Podcasts, or wherever you are listening. And if you enjoyed the show, please leave us a 5-star review. It really helps support the podcast and allows us to keep creating new episodes that show you that in finance,
the most important things aren't what to do, but what not to do. That's truly all for this episode, and we'll be back next Wednesday to talk about the dollar crisis and its impact on our portfolios. Right here, as always, on The Bull, your personal finance podcast.